Every decade or so, dark clouds will fill the economic skies, and they will briefly rain gold. Warren Buffett. Investor, philanthropist, business magnate, and the CEO of Berkshire Hathaway, Warren Buffett knows exactly how to deal with investments for a better return. There's no doubt Warren Buffett is considered the king of making the right investments. One lesser-known fact about this genius investor is that he started investing at a very young age, most probably when he was just 11 years old. Right now, he's one of the most successful entrepreneurs in the world and knows the exact timeless recipe for making unbelievable profits. So if you've been wondering what's his secret recipe to becoming a top-notch investor and how you can utilize it effectively to invest in 2023 to gain sustainable returns, then stay tuned. Moreover, with inflation upon us going into 2023, investing can bring big-time trouble. So how can we make fruitful investments in 2023 considering ongoing inflation, crises, and other chaos? And why exactly does Buffett have a big proportion of his money in cash right now? Well, we will reveal all of that in today's video featuring Warren Buffett's recommendations on how you should invest in 2023. So let's not waste any more time and dive right into them. Number 1. Crashes are the best time to get rich. The most obvious question that many investors come across is when is the right time to invest in the market? Is it when it's at its peak or when everything's on sale? Worry not, because Warren Buffett has an answer for this.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
Warren Buffett has not only said but also proved that crashes in the investment world are the perfect time to become rich. He explains that if you want to become a successful investor, you must know the right time to buy stocks and sell them. Most people usually avoid investing when the time is odd. They don't do this intentionally, but whenever the time is uncertain, fear makes them hold back. So be aware that whenever there's bad news, stocks are plummeting and everyone is selling their shares, this is actually the right time to invest. Rising interest rates and uncertainty in the market will result in great opportunities this year. This is when you need to cash in and make a lot of money. In Warren Buffett's words, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Number 2. Consider making investments a game with no strikes. As 2023 has already started, we realize that the economy is unpredictable. One moment, you're getting profits, but the next, you can't anticipate that it'll work the same way it was running previously. With military conflicts rising, inflation booming, geopolitical issues, and of course the current global cryptocurrency financial crisis, we can't expect a business to thrive with the same vigor of a decade ago. Warren Buffett believes that if you're thinking of investing in 2023, you have to avoid short-term economic problems, and we must invest in the companies that are in our circle of competence. Investing is a game. And accordingly to Buffett, this game has no strikes, which is the most amazing thing about it. He means that you'll see stock after stock fly by, like pitches in a baseball game. But like a batter, you should only swing at those in which you feel the most confident. Warren Buffett explains that he always knew his capabilities before investing in anything. He's clear that investing in something is just like a baseball game, and he was always aware of which pitch to hit to get the maximum output. But remember, no matter how wide or expansive your circle of competence is, make sure that you're aware of the edge of this circle. Always be aware of what lies outside your competence circle, so you'll be able to avoid losses. Number 3. Be mindful of interest rates. According to Buffett's explanation, interest rates are to stock market valuations as what matter is to gravity. The lower the gravity, the easier it is to jump, and the higher the gravity, the harder it is to jump. As interest rates rise, gravity pulls harder, making it harder to jump. So even though you shouldn't let the macroeconomic environment influence your personal investing, it's critical to keep it in mind. Buffett explains that interest rates must be kept in mind no matter what kind of business or organization you're in. He thinks if you let go of interest rates, you might land in deep trouble and actually lose your ground. Nowadays, as inflation is rising, tracking interest rates can be a tiresome task. However, to remain on the run and avoid any deep shocks, you need to be mindful of interest rates, no matter what. But what about inflation? It seems that this year, inflation will be a big story. So how can we continue to invest in such a tough time when everything is nearly on the verge of a breakdown? Warren Buffett explains that as an investor, you must invest in enterprises that possess two qualities. One, the ability to raise prices without much difficulty even when the capacity is underutilized and demand for the product is flat. And two, the capacity to accommodate huge dollar volume increases in business, which are frequently driven more by inflation than by real growth. Inflation can have a significant impact on investment portfolios as it can erode the purchasing power of money over time. To help mitigate the impact of inflation on your investments, it can be helpful to consider investing in assets that are expected to increase in value or generate income faster than the rate of inflation. Warren Buffett's approach of investing in enterprises that have the ability to raise prices and accommodate large increases in business volume can be a good way to potentially protect against the impact of inflation on your investments. Companies that have strong competitive advantages and pricing power, such as strong brands or patented products, may be better able to maintain or increase their profits in the face of inflation. Take, for example, companies like Coca-Cola or Apple. Number 4. Investing in overvalued markets.
But three wonderful businesses is more than you need in this life to do very well.
If we look at the past, Warren Buffett didn't always keep his money in cash. However, he warns that he'd rather have his money in cash than invest anywhere just because he has cash. This is because he believes that you should save money and wait for the right opportunity instead of investing it in overvalued assets. That's why he's holding most of his cash right now, waiting for the right opportunity. Buffett believes that you can make the most out of your investment when you wait patiently for the right opportunities. He explains, with all the things going on in 2023 relating to the economy, it's not a good idea to buy average investments in a very overvalued market. Buffett's approach is often referred to as value investing, which involves looking for undervalued or underappreciated assets and buying them with the expectation that they'll increase in value over time. This approach requires patience and discipline, as value investors may need to wait for the market to recognize the value of an asset before they see a return on their investment. It also explains his viewpoint, which goes like this. You don't need that many great stocks in your whole life, but 3 wonderful businesses is more than you need. So, the truth of investing in 2023 is to exercise patience until the market provides you with an amazing opportunity. Number 5. Passive investments. Making passive investments is another strategy Warren Buffett believes everyone must consider in 2023. Warren Buffett has been a proponent of passive investing, particularly for individual investors. Buffett has often said that most individual investors will be better off with a low-cost, passively managed investment portfolio rather than trying to pick individual stocks or actively manage their investments. Passive investing can be a good choice for those who don't have the time or expertise to actively manage their investments, or for those looking for a low-cost, diversified investment strategy.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now.
The passive investor doesn't have to try to buy at the best time to invest. Due to the nature of the dollar-cost averaging technique, you must continue to purchase market-tracking assets at the same intervals, rain or shine, to obtain the market's average return, which, by the way, is approximately 8 to 10% annually. The dollar-cost averaging technique, which involves investing a fixed amount of money at regular intervals, can be a good way for passive investors to build their portfolios. This approach can help reduce the impact of market fluctuations on an investment portfolio and can be the best way to build wealth over the long term. For passive investors, Warren advises not to be concerned about whether the market is high or low. Instead, just keep going. Never read a headline, never glance at a chart. Simply stick to your approach and the stock market will be your best friend. Number 6. Acknowledge what's happening in the market. Warren Buffett is a strong believer in keeping a check on the market at all times, and we can see this from the investments he's made. He's always aware of the market and what's actually going on inside it, who's going through a loss, or who's getting all the profits. Buffett knows everything, and he encourages everyone to read newspapers and business magazines daily, keeping a keen eye on market patterns. So, the best way to invest in 2023, according to Warren Buffett, is to keep up with what's happening in the market. By doing so, he believes you'll know exactly when to invest in an asset and when to get rid of it. Staying informed about the market and being aware of what's happening can certainly be helpful when it comes to making investment decisions. However, it's important to remember that no one can predict with certainty what will happen in the market in the future. It's always a good idea to diversify your investments and be prepared for potential market fluctuations. It can also be helpful to have a long-term investment strategy in place rather than trying to make short-term moves based on market fluctuations. This can help reduce the impact of market volatility on your portfolio and can increase the likelihood of achieving your financial goals over the long term. Click here to learn the 7 critical habits that Warren Buffett believes are keeping you broke and poor and how you must avoid them.